Alright folks, welcome back to the ICT Mentorship Weekly Review. This is week ending March 22nd, 2019. We're looking at the economic calendar, general commentary on the dollar index, euro dollar, GBP, and the buy-side imbalance, sell-side inefficiency, and sell-side imbalance, buy-side inefficiency. Okay, let's take a look at the economic calendar. Okay, so on Monday we have the IFO, Business Climate, 5 a.m. for euro dollar. Tuesday we have building permits and consumer confidence for the dollar. New York session. Wednesday, New York session, we have Canadian dollar high impact trade balance. On Thursday we have preliminary CPI for euro dollar, and on the New York session we have final GDP. And on Friday we have current account, GDP for British pound, and net lending to individual. And 8:30 a.m. we have high impact Canadian dollar GDP, core price index, and personal spending for the dollar index. 9:45 we have Chicago PMI, and we have consumer sentiment at 10 a.m. and then obviously the Parliament Brexit vote, the ongoing drama that is Brexit. All right, so we're looking at the dollar index. This is a daily chart. You can see here we have a sell-side imbalance, buy-side inefficiency right in here. At the time of this recording, I was recording at about a couple minutes before 2 o'clock, my time locally, on Friday afternoon. Trying to get a head start on the weekend, folks. But the market has tried to press up into that area in here. Take a look at the lower time frame and see what has been left as a remainder of that SIBI. So again, SIBI is sell-side imbalance, inefficient because it doesn't offer enough buy-side imbalance. Not imbalance, imbalance. So what I'm saying is it's all sell-side delivery here. No real buy-side's been offered until we've come up into the range here. So once we trade back in, close this in, we'll have to determine at that time what the market may want to do. Now, before I go any further into the lower time frames, the mean threshold of this last up close candle, if we trade through that on a closing basis, I will change gears on the dollar index and move to a bullish stance. Until that happens, I'm not bullish. Okay, so I'm looking for bearish dollar index. And like I said, this thing can stay sideways and the other foreign currencies can move all over the place. I think that they're holding this for a longer term run above 100. So that's, again, a long macro view of what I think the dollar index is trying to do. But obviously that'll change if we make a significant run below the January lows. Moving on over to the hourly chart for dollar. You see we have a buy side liquidity pool here, equal highs, too clean. Here's the closer version of that SIBI, sell side imbalance, buy side inefficiency. We've rallied up into almost this entire range. It's left it open to some degree, and we'll look at that when we get to the 15-minute time frame. We'll talk about this little area in here. This is called a sell side imbalance, volume imbalance. All of this price action in here, okay, from this candle to here, we created a gap. Whether you see the gap or not on your data is irrelevant because it's still there. It's acting in the same capacity this will over here. Okay, but when we have a missing body, okay, a candle that didn't paint enough to create a body in an area of price action, or between two specific price levels, that's an imbalance on volume. Okay, so there's a lack of trading there. Now, couple that with the idea that it's the same as you would see here. Okay, this is inefficient. What makes this inefficient is because it's one quick sudden candle down. There isn't a lot of back and forth price action, for instance, like we see as the market trades lower here. Okay, what's the difference between this approach to delivering price back and forth as it drops and this one. This is highly inefficient because it only offers a quick repricing lower. Every price level between this candle's high and this candle's low did not get enough sufficient time made available to it so it could be traded. Now think about what I just said there. This candle, and from the period of where it starts the candle and ends the candle, this entire candle, price was not permitted to stay at a sufficient amount of time at a specific number of price points or levels inside of that total candle's range. We're led to believe by educators, we're led to believe by brokers, by whoever's supposed to know more than the rest of us, that all of this movement here is attributed to short selling. It's not. It's being completely controlled and it's manipulated. These prices, if you sold short and you were a part of that move, it's easy to attribute that to say, okay, well, I was on the right side with the sellers. There is no selling from the algorithmic standpoint. The algo is delivering price. What we do as traders at the bank level or as retail traders, because we're all retail here, if we do not execute at those price levels, the algo doesn't care. It's moving around based on its programming. Over here, the difference, how prices dropped lower, is because it's much more efficient. As it drops down, it comes back. So it offers more of the range back and forth as it moves up and down, offering price. Price makes a lower low, and it comes back. Moves lower, comes back. Moves lower, comes back. Moves lower, comes back. So all of this range in here is much more efficient because it offered more time and it offered more availability to buy and sell side. More specifically, it offered more buy side delivery during the length of time. Okay, so what makes this inefficient again? The short span of time, and this makes it efficient because of the long length of time. So in other words, this range in here to here, so the high to low, if you look at this whole move from here to here, it's very close to it in terms of the number of pips. It's not identical. I'm not trying to argue that point, but I'm saying that if we look at the two contrasting price points from high to low, this is highly inefficient. These events are typically filled back in because the algorithm will want to come back up and offer, as you're seeing here, a measure of buy-side delivery. When I say buy-side delivery, that means an up movement in price. That's all I'm saying. Now, ideally, we want to see a candle paint, okay, or create itself and then leave bodies inside of this area, not just wick up into it. That's important too. But the difference between this area here, which is a sell-side imbalance, volume imbalance, okay, CIV. I say these four-letter acronyms because it's a lot easier to, number one, say it. Two, it makes you think about what's going on also. So when I have them in my charts, I'm communicating the fact that there is an imbalance. So there's a repricing so fast down here, there's no sell-side delivery at all. Again, your broker or your feed may not show this, and that's fine. But this essentially is the same thing that's going on many times in here. Just because we see our candle paint an entire one big bar or candlestick, internally, this is what we're actually seeing, that inefficiency. There's gaps like this in between price points. So this is actually a much more appropriate visual aid in terms of this, deciding whether or not the market is efficient or if it's efficiently delivered. Because it's missing a complete area of price, this gap needs to be refilled. Now, when price comes back up, it fills it and rebalances, doesn't it? No, it hasn't. It does not rebalance until it offers sell-side delivery. What did you just say? In this area here, from this candle's close to this candle's opening, buy side was offered to this price point here, leaving this area right in here, this gap, as a civvy. Sell side imbalance, volume imbalance. It's missing a chunk of data that would be offered in between those two price points or those price levels. Watch what happens in here. Price runs up. Yes, it closes that gap, goes a little bit further, but now what does it have to do to be efficiently traded? It has to go back down in between this candle's close and this candle's opening, or to the wick high, because buy side delivery is offered from the opening to this high. So from this candle's high and this candle's close, there has to be sell side delivery. We get it here. Boom. It also fills in a buy side imbalance here, comes down, closes it, and also hits an order block. So notice all the confluences of things occurring at that same price point. The teaching is highly specific to this area here. There's missing sell side delivery. So when it comes back up, this is not the completion. That's not it. It has to eventually come back down. Then we have officially rebalanced this price point. Remember, institutional order flow, as I teach it, IPTA, the interbank price delivery algorithm, has to have balance. It has to have balance. That means it must trade up through a price range and then back down through a price range. And once it does that, that range is now balanced. Once a range is balanced, then equilibrium becomes a significant factor. But until then, equilibrium is not a factor at all. Okay? So we have CIVI rebalance here, and then price comes back up, going into the CIBI, sell side imbalance, buy side inefficiency. You're going to want to watch this video a few more times. Okay? Let's move on into the 15-minute time frame. Here's that CIBI here, again, zoomed in. This is the entire range that's left exposed and open, and it closes to this price point here, leaving this range here to this high unfilled. Then on this run here, it comes back all the way to this price point here and then leaves this little shaded area that's slightly different in terms of color. I guess that's going to be as close as I can get to referring to as pink, maybe. But I didn't pick pink. It just creates that because of the overlapping colors. It is enough of a contrast to communicate the method nonetheless. So we're looking for a likelihood of coming back up into this area, closing in this sell side imbalance, buy side inefficiency. Once we trade to that, we'll have to determine whether or not it wants to go higher or lower. I believe it wants to go higher for that equal high as we showed on the dollar hourly chart. We also have a gap in here. Okay, so there's a volume imbalance as well. This is a BIVI, buy side imbalance, volume imbalance. It's missing a little portion of price action. What type of price action is it missing? Sell side. So not only will price need to come back down, but it needs to come back up and again. Then this area here will be efficiently balanced. You can actually see there's a missing portion of price action in here. There's a missing portion of price action in here. Again, all of these elements are synonymous with what we expect to see inside of these candles, but we don't necessarily see them because one single candle from open, high, low, and close, if it's one candle, you won't see the breaks or the missing portions of price where it did not paint or offer those specific price levels. That's why when we talk about dropping down into a lower time frame, what I want you to do is inside of these single candles, many times there'll be smaller little breaks in between where there's one single candle. That is the area at which IPTA will want to reprice to and rebalance. That, when we have a bias, is an institutional order flow entry drill. And when you have context correct and time of day right, and the day of week right, and the long-term or the intermediate term bias right, and you have the strongest pair when buying or the weakest pair when selling, that is a complete system. You'll want to rewind this portion of the video and listen to it again, because I just told you what you're listening and looking for every time you watch a video. I've spelled it out for you. All right, so moving on over into the euro dollar. Euro dollar, we had our buy side liquidity pool mentioned last week as a objective. That's where we were looking for price to go to. What is residing above that old high? It's buy side liquidity. That liquidity has been purged, traded all the way back up into this bearish order block. Now, why not this candle, Michael? It can be. I'm just showing you the actual precision of the delivery because this is sell side delivery. So we have to go back to from the left of when sell side's offered as an initial price move lower. We go back, and where's the first up close candle? It's this one here, but we look at a beefier bodied one here. So you can use this one. There's nothing wrong with that. Specifically aiming on the open to the midpoint of the body in that range. That's going to be where the sensitivity is going to be. Here, this just so happens that it offers the cleaner delivery for a bearish order block. Specifically, in other words, I'm using, even though this is a larger body candle, this is smaller inside of it. So inside that larger body candle, it's going to be the smaller candle. Just like if we were looking at a smaller time frame, we would reduce our focus down to the smallest up close candle, narrowing down into where the true order block is from the lowest time frame, because you're going to be able to see the benefit of the lower time frame is you can see when the inefficiencies are completed and the imbalances are rebalanced. That's the only real benefit of intraday. But because most people are not taught and trained like you're being taught, intraday charts end up hurting them. It gives them a false impression. There's a lot more signals and setups that's really not there. So we come back up to the pip, beautifully delivered, right on the pip, and then a repricing lower. I mentioned earlier on Wednesday's review, I said that last week I talked about that I'm going to be watching this area in here. We'll see in a lower time frame how it struggled in that area, and then finally price took off, hit our liquidity pool, and now we've come all the way back down in. Here is another nugget, okay, of wisdom as it relates to inefficiencies, okay? No one's teaching what I'm teaching you in this video, okay? So I want you to understand that. And when you guys get into social media and you're throwing my things around like they don't mean anything to you, they mean a whole lot to me, okay? I've lost fortunes learning how to get this stuff, okay? And when you're just sitting around on social media and you're just throwing them around, not only is it disrespectful, but you're actually giving away content that is really not meant for the public. So if you're learning this, just keep it to yourself. It really is, it's too good. It really is too good. So when we look at repricing, price comes down from this low, starts trading up. If we look at how price is being delivered on the buy side, between the separation of this candle here and this candle here, we have this one up close candle. The previous day's candle to the left of this one, the high comes to this price point here. The next day it opens, trades down, but does not come back to this candle's high. So this single pass on this one candle up, there is a buy side imbalance, sell side inefficiency. Same thing is said here. This candle on the upside stops here on the high. This is Sunday. Then we have a trade higher. This price range right in here on this single candle is a buy side imbalance, sell side inefficiency. So it's a BISI. So the red levels that I have here highlighted, they are specific ranges of inefficiency. Price will want to go back down into them. Now they can be targets or they can be entry points. If we are going to see a higher dollar index, price could drop down a little bit lower and come into this area and rebalance. Once it does that, it's also the mean threshold of this down close candle here, and that could be something significant to cause support. It offered an opportunity to be a target here. Once it filled its objective of running the liquidity here, IPTA ran up, offered the price there, and then sudden repricing lower. Moving into the hourly chart, you can see that buy side liquidity pool here and the purge on that liquidity, trading back up into a bearish order block. And if you go into lower time frames, you'll see it. Nice little run away and come back up into bearish order block here. Look how much time we spent struggling around that daily range. I said that I would be watching to see what we do on how we trade around that. It wasn't until FOMC, you seen price come up. They used the FOMC to run the liquidity over here. We got a breakdown, small little SIBI in here, sell side imbalance, buy side inefficiency. Trades right back up into bearish order block. This is the PMI number for Euro. It was disappointing. They had a number of 50 something in February, and it came out to like 47 or something, maybe 48. It was lower than they were expecting. The reaction here is all programming. It's repricing based on IPTA. Yes, the number was bearish for Euro, but that's not the deciding factor, and that's not the only thing that causes these types of moves. The reason why I teach you the economic calendar is because IPTA will work specific macros around high-impact news events. Now, there's also many times that you're going to see a really low-impact news event that IPTA will reprice aggressively against, and you're thinking, wow, that wasn't expected to be that big of a deal, and all of a sudden it was. It's not a measure of how much impact it is for IPTA. I just like to focus on the high impact to medium impact because I know IPTA will want to do certain things that I teach you and then hunt for liquidities above and below the marketplace relative to that idea. So in other words, we use the economic calendar as a volatility injection, okay, and a way of saying it cleaner and more easier to understand is it's a smokescreen hiding what the professional perspective is. So if you get caught up in the noise, like FOMC, it looked extremely bullish, rallied all up. It went right to where we said it was going to go before the week even started. Didn't spend much time up there and then ran away. Nice little run up in here. Efficiently traded, inefficiently traded, comes back to the price point where it's efficiently traded, then stops and moves lower. We have an inefficiency here. So we'll look at a lower time frame in a moment. But here is that same range, beautifully coming down into it relative to the daily chart. So that SIBI is perfectly rebalanced there. And we have one more here. On the lower time frame, hourly chart, right below these equal lows, that SIBI also would complete. So we have a liquidity pool here, which is nice confluence. So in the 15-minute time frame, you can see how price trades aggressively lower, okay? From this price point here, this is the old daily high. That's what this horizontal line is. That old daily high that we were aiming for, and this was the run above that, to run the buy-side liquidity. Okay, so buy-side liquidity is purged. Price has a repricing. Does it have to come back up to this price point to rebalance? No. It only has to come back to this price point here. So the gap really only exists between this low and this candle's high. It's important what I just said there. Why is that? Why isn't it this whole area in here, Michael? Why isn't it from this price point here to here? Because we worked a higher time frame high. That's a run through here. We came back and rebalanced it, tried to rally again. This small little, fractal rallying higher, I would only look for this low to be traded up to as a rebalance. And it didn't do that, which means it can be left as a common gap. Price trades down, comes back up, doesn't quite get to that area, so that means this is a common gap. Or it could be a breakaway gap. Price trades lower, comes back in again. So right away, we're efficiently trading lower versus a run down like this, okay, or a run down like this, or a run down like this. Inefficient, only from this price point here down. We balance most of it. Inefficient, we rebalance right in here, sell off again, rebalance, sell off again. So now what's actually occurred in here? We have a balanced price range from here to here, and then we have a smaller range from here to here that's rebalanced. Why is it rebalanced? It's efficiently delivered on both sides, up and down. There's been down close candles and then up close candles between the high and the low. The bulk of that has been rebalanced. That range now you can use that as an equilibrium price point. Equilibrium also gives us the middle point of this last up close candle, which is a bearish order block. Extend that out, bam, it's only off by 1 pip. There's your PMI number coming out in London, 4 a.m. New York time. Boom, explodes to the downside. Okay. The effects of efficiently delivered and inefficiently delivered price is something you're going to have to study, and I harp on it all the time. It's maybe not something you're going to learn right away, and if you don't still get it, you'll get it because of the examples I'm talking about. Just know there's a stark contrast between how much time it takes a price move from one level to another versus like this. Highly inefficient. So inside of this area where price has been offered up, I watched this live as it happened. I think it only offered like 4 or 5 price levels. It was only like boom, 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 and it was already up here. So it has to come down and reprice, offering sell-side delivery. And once it does, then it can start to move back up and offer where there's gaps in here. It'll refill on the upside until we get to an economic calendar and volatility injection occurs. Then the market will seek what? Another level of liquidity. Right in here, perfectly delivered to the pip. That's that BISI, buy side imbalance, sell side inefficiency, relative to the daily chart. Right there. You don't see that on supply and demand. You don't see that in Chris Laurie's stuff. You don't see that on anything except for here. This is institutional order flow. It's not depth of market. You don't need ladders. You don't need point of control. You don't need volume. You don't need none of that stuff. Okay? Price is telling you everything you need to know if you understand what it's telling you. It's a language. Okay? Price is speaking in a language that is written in 3 different ways: accumulation, manipulation, and distribution. Its vocabulary is open, high, low, and close. That's it. That's IPTA. And time. And time is the variable. That's the part that's going to hurt you because you don't understand the when. When is the imbalance going to occur? We don't know. The likelihood is when the volatility injection occurs relative to the economic calendar, but they can occur anytime. But when we have that imbalance, it gives us opportunity. Okay? Moving on over into cable. Now, cable, this thing, I honestly, I don't know. I don't know, and I really want you to understand I don't know. So I want you to be very careful. If you want to be smart, okay, just stay out of it, because this is nothing in here is high probability right now. We have equal highs in here. They may want to run those. Obviously a liquidity pool here. To me, I think they could still pump this thing higher and clear out the 13th high. But what we do from there, I don't know. And I want you to appreciate my honesty when saying this, because I'm learning as we go with Brexit. And I'm glad that I keep a hands-off approach for the most part in it, because there's several times last week where I was looking at certain things in price that would have otherwise led me to get into a trade, and I didn't do it because it would have broke my protocol. I don't understand something like Brexit. I don't. So because I don't understand it, I'm not going to stand in front of a Mack truck while it's barreling down 100 mile an hour at me. I'm just not going to do it. Or stand in front of a train and challenge it to knock me over. It will. So because of that, I think it's important that you, if I'm not willing to touch it and you're learning how to do this, why would you ever consider doing it? If I'm telling you I fear the stinger, okay, that may be embedded in me by this pair, why would you want to go, well, I'm going to show him? Don't do that. This is one of those times where you just don't need to do those types of things, okay? When there's not a fundamental driver like Brexit going on, and if you want to outperform me or outtrade me, be my guest. But in here, I'm trying to protect you. That's all I'm trying to say. Is just capital preservation is the rule number 1. Moving on into the 15-minute time frame for cable. Again, We have a nice little imbalance down here. Buy side imbalance, sell side inefficiency. Came down right to the middle point of that. Again, that's order flow, institutional order flow, entry drill. Real nice little opportunity there to practice on paper, not with a live account. And again, we have equal highs in here. So there's several layers of liquidity pool here, here, and the 19th can still have a lot of liquidity too. There's a lot of folks that are gambling, and they're wanting to sell short this currency. And I think if it goes down, they're going to really want to rate it significantly higher and scare everybody from wanting to be short on it. Okay, so say I'm right and they send the dollar to over 100. Okay, longer term. And how much is that in terms of time? It could take years, much like I did, good grief, almost 7 years ago, 8 years ago. I said that we would trade up into the 102s on the dollar. And we got there. So it's one of those types of calls. Is it something that is necessary or that you need to trade with? No. But if I'm right in that long-term macro analysis, that's where I think they're going to try to send dollar, it may lead to a longer-term erosion of the pound sterling. I just say it like this, okay, and it's not meant to offend anybody, but this thing is way overvalued. There's no reason for the pound to be valued like it is. It needs to go lower, and longer term, I think there's going to be parity between it and the dollar at some point. And how long it takes to get there, long time. And I don't know what that crystal ball answer is for you if you're asking. Don't send me an email because I don't know how long it's going to take. Moving on over into the dollar CAD. You guys watched me do this morning's scalps for dollar CAD. I went long. The question is going to be, and as they were on Twitter too, how did I know to trust dollar CAD going higher? Well, we traded down into the area on the daily chart for the dollar index I mentioned as last week's objective. Well, we traded down there. And once it trades there, do we continuously look to trade? No, we have to go into what mode? Reversal Markov profile. So we showed the unwillingness to go lower on this day, and then we went to this price point here, didn't go lower, and then we rallied all the way back up. All of this was filled in, and then we blew out the highs, and then we blew out these highs, and we were in close proximity to the 134 big figure. Okay. I gave you a method of trading big figures in Wednesday's teaching of this week here. So on the 20th of March 2019, if you did not see that video, go back and watch it, and I talk about how to use inefficiencies around the big figures. Well, I also mentioned that everything I said about it relative to big figure or 00 levels can be used for the mid figure level, 50. So we have price running above the mid figure, and it creates a gap. So we have a BISI, buy side imbalance, sell side inefficiency. This candle's high here, and this candle's low here. One single candle passed between that range at the low of this candle and at the range of this candle's high. So this whole area in here is imbalanced. That means it's only offered the buy side efficiently, but it has not offered sell side efficiently. Okay, so it's an imbalance. There's more buy side offered and less sell side offered. So the imbalance is too much buying, not enough selling. That's how we interpret it as traders. What's really going on is it's too much buy side delivery of price and not enough sell side delivery of price, because price is not being pushed around by buyers and sellers. That's not happening. That's a myth. You can argue with me all you want. When you can find the precision like this, then you can argue and tell me what your methods are telling you. But this is what actually goes on every single day in every asset class. That buy side imbalance, sell side inefficiency, that's what I was looking at when I woke up. Now, I slept in today, as you guys saw on Twitter. I missed the really nice moves in Euro. I missed a nice moves initially buying what I'm going to show you here. But looking at the dollar CAD, as it trades down right in here, is that a time of day that we will be trading? Well, it's late in New York on the 21st yesterday. From a swing trader or a short-term trader, this could be, if we had a really nice setup and not going into the weekend, okay? On a Friday or Thursday, not so good, because I don't like carrying risk and gap risk over the weekend. What's gap risk is whenever we open up on Sunday, it can do whatever it wants to do on Sunday, and many times it's going to be what you don't want it to do. So to save myself gap risk, I don't trade over the weekends anymore. I used to do that. I don't do it anymore. This inefficiency on the buy side, they offered a sell side delivery here, so it's rebalanced. Is it? Look closer. There's the high. There's the low. There's a range in there. This portion of the range is left open. Right below that would be stops. Imbalance is right in here. Price trades down until here. This time of day is now London. Now, is that an appropriate time to look for longs? Absolutely. What are we looking for? A run to the big figure. Okay, great. Now, what's the protocol if we get to the big figure? It can go 10, 20, 30, 40 pips if we hit the big figure. Let's fast forward it. Here's that low. It hits it. Expands up. Right in here, I wasn't wanting to go long based on what I just showed you. All I did was use New York setup to get in sync with what London already priced in. Price runs up above the 134 big figure. You watched me execute above 134 on my exits and partials. You watched the limit order fill ahead of the 134 big figure, 3 pips below it, for a perfect 20 pip opportunity. And I told you I would be trading dollar CAD last week relative to the economic calendar. Remember? Go back and watch it. So prices meandered in here, traded up into the 20 level, just above it, went to 26, I think it was, as a high, 134.26. And then we have these equal highs. So it looks as if it may want to press higher. At the time of this recording, I don't know if it's consolidated still, if it went lower or if it went higher, I don't know. But it should want to go higher to clear up any more liquidity that would be anybody trying to sell short or fade this run. The order flow and the entry drill that I gave you, that is like the $1 million entry technique. Okay? When you understand what you're looking for, you're getting in at the low when you're buying. And when you're going short, it's many times putting you at the pip high of the swing. There's nothing better than it. You don't need any other entry technique. It absolutely is awesome. Go back and look at all my baby pip stuff, and you'll see where I had trades and showed you what I was doing, how I did it. Everything that was not in those videos is what you learned just this week. Think about it. I gave you a ton of precision elements about getting in and getting out. This is not free tutorial level. This is what you would expect if you're part of the mentorship group here. I don't want you sharing this stuff on Twitter. So when you send things to me, I understand your excitement. I understand your enthusiasm. I know what it's doing in price. All you have to do is say, what you did. Okay? In other words, don't talk about it with the details. Because all you're doing is teaching, without realizing you're doing it. And if you talk enough, I have brought them to a level of understanding that the free tutorial levels has a lot of depth in them, and it's just gaps in the ideas. You're actually going to fill in those gaps involuntarily because of your charts and because of your enthusiasm and talking about, this BISI, this SIBI, this, whatever level. It's going to start clicking because, believe me, most of my followers, okay, they know my free tutorial stuff. You're learning all of the gaps in that. And there's so much more that I haven't touched yet. And I hope you appreciated this month so far. We have one more week. Obviously, I'll talk about framing New York setups next Wednesday. But I did exactly what I'm going to teach you, and that's why I'm holding off. You're probably saying, well, you're not really showing me what you did. You're right. I'm going to teach this in next Wednesday's teaching on framing New York setups. So for the folks that are in here that had their feelings hurt because there's a lot of work involved in this, that are thinking they have not learned how to trade, they have not been taught when to buy and when to sell, where to put their stop, when to move the stop, when to take partials, how to pick a target, all of that stuff's been taught. You're just overwhelmed and bewildered by all of the content. And it's by design. I want you to know everything, and then I pull things in conceptually into a model. Obviously, you can see I'm using it every single day. And you can see the signatures in certain things. Oh, I can see what he did there. But how did he know this and this and this? That's what mentorship is. There's a lot of theory, and that's the part that's boring. But that's the part you need. And I couldn't have done the long run of building up a carnival-like atmosphere when I was on Baby Pips if I just talked about theory. Nobody would have watched the videos. Everybody was watching me do a simple little thing, optimal trade entry. Here's a fib, getting on here, buying and selling, and there it is. There's a whole lot more to it than that. And you're learning it. Okay, so hopefully you found this week insightful. We'll be building more on this on next week's lesson, but this here is exactly what I taught you relative to trading the big figure. Around the big figure and also the mid figure, if there's an imbalance and we have a directional bias, find the inefficiency, target it, there's your entry with a kill zone. Bingo. There you go. All right, so looking ahead, technically speaking, next week we have March 27th, framing New York setups. And other than that, that's going to be it. That's a wrap. So I wish you all a very pleasant weekend. Rest up. Get ready for another wild week of Forex action. And until I talk to you on Monday, I wish you good luck and good trading.